Welcome to your latest edition of The Officials. We have some standards and some new things to share with you. I'm welcoming two of my colleagues here, Ed and Will, who will participate actively in this discussion, I hope. But at the beginning here, I would like to say never forget to like our podcast. It helps disseminate the good word, and we know how much you enjoy them. In fact, I wanted to start a little bit off peak. We had a meeting this morning with the Saudis, and they were telling us we were rather surprised that our officials are read all the way into the Ministry of Energy, of course. And also, our officials' podcasts are also watched by the personnel there. So we are really, really pleased with that. And one of the things they ask us is to stay out and discuss market issues, what's happening with Dated Brent. They had many concerns about that. What is happening with Dubai, and what is happening in general in the direction of travel of prices. So why don't we start a little bit with those themes? We seem to be on the front desk of very senior people. So on the issue of Dated Brent, the topic of discussion was, our premise was that the addition of Midland TI heavily resulted in more volatility rather than less volatility in that market. And that our expectation prior to implementation was that we would have higher highs and lower lows. So without going into too much detail, Will, what did you hear from them? What was their concern?
Yeah, I mean, it was whether the Dated Brent benchmark really functions as the global benchmark anymore, whether it's still representative. And like you said, that we've been seeing this year after the inclusion of WTI, a lot more volatility in the physical diffs. I mean, just this week just the past 2 weeks, we've seen the physical diff go from over $1 down to flat, and then now back up to around 14 cents. So it certainly seems like that volatility is proving persistent, and it's not really reflected in the futures curve either. Like we're seeing a pretty consistent 40 cents worth of backwardation in the prompt spread on Brent futures. So there's a dislocation there between the physical market and the futures.
Yeah, the disconnect is obvious because you have the same market in backwardation and the same market, you could say, in contango. And we see that on the CFDs. So why that is, in my opinion, and I think I'm going to call myself a self-expert in those things, is poor construction. And it has been attracting not only my attention, but it seems very senior people. So I would say designers, get back to that drawing board and think it again. And if you have to say we got it wrong, it's better to say we got it wrong early rather than later. The other thing, and now let's switch to more current markets. The flat price is roughly, give or take, $75. And every day we hear noise from very excited traders. Oh, the bombing is happening today and it's going to go to 80 or 77 or whatever it is, or nothing is happening and is dropping. And one of the phrases we have heard from people in the trade is, and we need to really think about this one, is the more nothing happens, the more nothing happens. Because the impact of the attack on the market will deteriorate over time. And we're very thankful about that because nobody wants to see any more deaths happening. The elections are coming soon. And hopefully that pressure from the US keeps from more people dying in the Middle East. No, I don't want to see that. I don't know of anyone who is sensible who wants to see that. Ed, what do you see on the odds on Trump versus Kamala?
Well, they've steadily been rising in favor of Donald Trump in the last few weeks, really, because it was fairly close to parity. And so far, the last couple of weeks, we've seen it rising towards 70% in favor of Donald Trump. on at least in the bookmakers. The polls are still showing a much closer race towards 50-50, maybe slightly favoring Kamala Harris. But this morning there was the final FT poll for who voters trust most with the economy, and Donald Trump had just surpassed Harris. So in terms of economic interest, clearly they're moving towards it, favoring Trump, but on perhaps the more social issues, Harris may have the edge. So it's everything to play for.
Yeah, this issue also came up in this morning's conversation about what would be the impact of one versus the other. If we take a very high level point of view, Trump is favoring tariffs and all kinds of import taxes. And by definition, the lack of supply, the higher tariffs will result in higher inflation in the US. And if he wins, that will bite him as inflation goes up. But he has a tool on his favor, which is the energy prices. If when he takes over, he tries to calm down the Middle East, essentially 10% out of the price goes out of the window, and prices then fall into the 60s. And that, as we were talking this morning internally on economic matters, one of the main headline items that result in lower inflation is energy prices, right, Will?
Exactly, yeah. So energy is contributing around -7%. So it's deflating that headline figure by around -7%. Whereas services sector's inflation is still above 4%. So yeah, the energy deflation that we've seen over the past year is the really big driving force behind that headline number coming down towards target, especially in the US and euro area.
And that would be negative for the revenue of the oil producers. But our advice is be ready. If you don't produce, somebody else will produce. And we have been focusing a little bit on the headline members that produce more than they should, or cheaters, as some people call them. And yes, we have hundreds of thousands of barrels, if not millions, over the headline number. So to close up on the issue, Ed, so you think Mr. Trump will win?
I think it's likely. I'm beginning, based on it's kind of the vibes trader that I'm channeling here. I think Trump is going to win the election, but Harris might well win the popular vote. So I think Trump will win the important battleground states, the Pennsylvanias and Wisconsins, those important swing states.
People got technical on these things for what it's worth. I was having discussions with some of my older colleagues outside of this office, and I always believe in democracy. And then somebody reminded me very pointedly that the US is a republic, not a democracy, and therefore is based on the law rather than the will of the people. But I hear the will of the people all the time. So I know I'm not voting, by the way. They cannot vote. But the will of the people should be reflected, but also the system should not be changed immediately right before any election. So before we get into politics, which are so divisive, as they should be, well, they shouldn't be, but they are, we should also go into other issues, such as the massive rise we have seen in gold. Gold is telling us something as it keeps on going up. It's roughly 2,750, give or take, per ounce, despite a very recent correction of 1% or so. It's still in that high level. This price is telling us something, and silver is also telling us something. What is it in your opinion, Ed or Will?
Yeah, so I think a lot of people are very quick to jump on the geopolitical narrative when it comes to gold. So a lot of people point to the elevated Middle East geopolitics, Russia, Ukraine, and even the US election. But I think it's slightly more nuanced than that. I think we're seeing a big rotation away from treasuries into gold in portfolios. And we've seen Druckenmiller, Paul Tudor Jones, people like that speaking on this. And it always comes back to the point of inflation. there's going to be record levels of debt hit this year, according to the IMF. We're going to hit $100 trillion worth of global public debt.
Hey, hold on a second. Just stay with me for a minute and think about that. Global, there is $100 trillion of debt. My head cannot process that. Because if there's so much debt, who's borrowing from whom and who's paying? All that means to me is that they're lending to each other funny money, right? Isn't that the case, Will?
Yeah, well, all this sovereign debt has to end up somewhere, whether it's in a pension fund or whether it's in a sovereign wealth fund somewhere. Someone's got to hold it. And when it matures, the government has to roll over that debt. They can't issue all the maturities all at once. So we've now got a pretty sticky situation where we've got, in the US, for example, next year, we're going to have over $7 trillion worth of treasuries mature. And now...
Plus new debt.
Mm-hmm. So now we have... And on that point, treasury yields are rising, right? Because people are selling their treasuries. So it's not just $7 trillion are maturing, but they're maturing at a higher interest rate. So the new debt that they issue will be less favorable.
So these things result in a misallocation of resources, crowding out of the private sector, where you take money from the private sector to give it to the government sector. And I think one of the reasons we are seeing oil underperform, as well as any other normal commodities and retail, is because the people are tapped out. This situation, I think, will continue to worsen. And at some point, governments are going to be forced to print like hell. And I think that time is coming soon. If that happens, of course, the price of oil will rise, but alongside with the rest, it's not that you're better off, but at least your nominal number is higher than you thought. So those are the main headline issues. I don't know if you want to go a little bit into the macros that you have seen in PMIs and things like that.
Well, this morning we got some more European PMIs, and it's still a pretty bleak picture. Let's be honest. Nothing's really fundamentally changed. They're still highly contractionary, and Germany and France are still the main culprits of that contraction. So Europe still looks very weak. But then, go ahead.
No, okay, continue. Yeah.
So again, as Will kind of alluded to, services. Similarly to the inflation issue, services is detached from the manufacturing. So services PMIs are performing better than the manufacturing and construction. So that's showing you that really there isn't the demand or the development of the manufacturing and the industrial aspects of the economy, and we're leaning more and more on the services, which isn't great for oil demand and material demand.
Yeah, and that would point out to a decrease or a crunch on several industrial items. One of them is industrial oils, heating oils, and this situation is global. Yeah. We shouldn't forget the fact that the EU, has put in higher tariffs for Chinese cars. And there are some very interesting data points coming out of China. Let me share them with you. The global sales of EVs in September have gone up by 30% versus last year to 1.7 million units. And the rise in China versus last year is almost 48% year on year as a total for the year. So as these things happen, it will continue to crunch gasoline. In our meeting this morning with the Saudis, we were very open in saying that we expect, I think we know that the peak in gasoline demand in China is behind. There's no chance in hell it will be growth. This has happened at a time that China will has issued new export quotas. Ed?
Yeah, so they've increased the quota for non-state refinery imports of crude oil by 5.7%. And some of that will be going to the Shandong Yulong refinery, which is opened just recently, and they're expecting to reach peak capacity at the end of this year. So if these non-state refineries take in all of this additional crude, these millions of barrels a day, and then they're producing loads of gasoline, loads of diesel, and loads of the other products, what are they going to do with that? Because if the demand in China isn't sufficient to absorb all of that, which we don't think it will be, China's not looking in a great place in terms of its product demand, then they'll have to export that onto the global market. And the global market isn't looking all that good either. So that could
just
then
a small
impact
correction.
prices.
It's millions of barrels per month.
Yes, sorry. Not
per
per day.
day. So sorry about that. But the fact is less internal demand, if we're right. And then there has to be more export. So we expect a rise in the export quotas, and that's going to put pressure on the European refineries next year. So we should get ready for some further closures and events in the European market.
Yeah, right? It's not a good picture already. I mean, Equinor this morning reported their profits, and year on year, the profits are 13% lower for Q3 this year than they were last year. So it's already a bleak picture. BP and Shell last week issued a guidance saying that they expected their profits to be weaker this year because of this, the weak margins. And we're going to see them next week and the week afterwards. So interesting viewing.
We're going to close with something very juicy. As Ed has indicated, the profit of some oil companies is coming down. This is at a time that we understand some subscribers to one of the main benchmark producers is facing several hundreds% increase in the cost of the subscription. We have heard from other subscribers that at times the salesmen tell them, we're charging you more because your profit has gone up. So if the profit is going down this year, we wonder if such issuers of benchmarks will reduce the rates to them. We recommend that you read today's officials, where we have some great artwork and also some comments about exercising dominant position. And with that, we'll close the officials podcast today. We'll see you next week. Thank you very much.